good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Ajay Sharma. And for now, the screen is looking quite good. We have seen decent amount of recovery from the lows. It might not look as exaggerated on the frontline index because it's off the highest point of the trading session. But again, the recovery is quite material in the small cap index as well as the mid cap index. And we are calling it material because almost two-thirds of the losses that we have seen yesterday are getting recovered today. Look at that 3% rally on small cap. Yesterday, of course, it was down almost 4.5%, 5% at one point of time. But there's a good amount of recovery. The advanced decline ratio is quite solid and looks like the weekly options expiry is likely to happen on the positive side, Ajay, because the momentum seems to have tilted at least a bit in favor of bulls now.
Yeah, you're right. I mean, yesterday at the same time, the advanced decline was 1:10 favoring the decliners. Now you're looking at 1:5, 1:6 favoring the advancing. And also one more important point to watch out for is today the market is just the reverse of what it was yesterday. Yesterday you saw the large cap universe doing very well and the selling was accelerated in the small and mid. Today from highs, Nifty and Bank Nifty may have given up some of the gains, very little, say 20% of the gains from top. Pull up the Bank Nifty as well, it almost fell back into the red, still in the red. But small cap and mid caps are very strong. In fact, in the morning, in the first 15 minutes of trade, the lowest point in the last 15-20 days was made in the Nifty and in the Nifty small cap and the mid cap, and then a reversal has come in. Very brisk buying happening as far as the broader market goes. Also, an observation that metals are doing very well. Look at how entire commodity universe, Nalco, Hindalco, Hindustan Copper, Coal India, ONGC, all of them gaining smartly in trade. Some of the IT stocks are coming back, and Adani group stocks, which actually saw massive drubbing yesterday, the biggest fall as a group in almost 2 years, lakh crore market cap got wiped. All of that is getting reversed today. So the interesting thing to watch out for or on radar would be PSUs coming back as well is something to watch out for. Whether in the second part of the trading session, which is an hour from here on, are we able to contain the gains made in the first half, or do we give up some of the gains? That is something to watch out for. Sandeep Sabharwal is joining us now on fundamentals along with Nuresh and Kunal on the charts. Gentlemen, good afternoon. Thank you so much for your time. Sandeep, let me start with you. We may have made a high on the mid cap, small cap, say sometime in the mid of Feb, and we were kind of grinding lower, but the selling got accelerated in the last 2-3 days. Looking at the screen now, are you getting a sense that bulk of the damage has already happened and one should start dipping their feet in the broader market now, or would you like to wait and see things settle down before starting to allocate money back to broader market stocks?
So settling down or not, it doesn't matter to investors like us. So what is more important is that to measure the magnitude of the correction and look at historical trends on how corrections play out and estimate if the correction is over. So by all those estimates, it doesn't seem to me that the corrective move could be over as of now because of the fact that we had a few days of fall. The correction from the top is not as much as what would typically be there in any bull market correction. And also the fact that the sentiment continues to be buy on every dip. So that sentiment has to become a bit more fearful for some sort of bottoming phase to be made. So I think we could be still a few weeks off a durable bottom. And I would think that speculative activity and stocks are still high because the kind of bounce backs we are seeing today, they also seem to be unnatural after the fall yesterday. So it's better to wait and watch. This is not the end of the rally. It is a bull market correction and it will end in a few weeks. And that will be the time to buy and then we could play the next supplement.
Okay, so the bull market is intact, but we might not be done with this correction yet. A few more weeks of grinding lower and perhaps then is when the durable bottom will be formed. That's the verdict coming in from Sandeep. But for now, India VIX has cooled off quite materially. In fact, that index is down almost 5% and now closer to the level of around 14. So at least the volatility seems to have been sucked out of the system for now. But Kunal, would you concur with the view of Sandeep that perhaps the bottom is not yet made? Or do you see signs on the charts that tell you that if not the bottom, we are very close to that?
So, ideally what happens, Anisha, is that after a sharp sell-off or a correction, there is a first flurry of a bounce or a relief rally. That's a more prominent term which we typically use for indices and for stocks. Post the rise or post this relief rally is where the index or stocks, they generally come closer to testing their previous support. So we call it as a double dip, where the indices or stocks which have fallen sharply, they go into retest of the previous swing lows. Ideally, in the second scenario is when the stocks or the asset classes, when they retest the previous lows, the volumes are much lower, because majority of the volumes, they generally get capitulated in the first leg of sell-off for the respective asset classes, and then starts a process of a very slow, gradual, steady recovery for the indices and for the stocks. So I would believe that we've completed the first phase of a sharp correction. We are in the process of a relief rally for individual stocks. Maybe this process could take another 1 or 2 weeks. But I think an ideal retest of the previous swing lows could probably be a more stronger determination that we formed a formidable support for the indices. So so far the Nifty mid-cap index, both of these indices are holding on to their key moving average supports. Just for example, the Nifty and the Bank Nifty both have come back to their 50 DMAs. The Nifty mid-cap index, we were discussing this yesterday, has come back to its 100-day moving average. So in terms of short-term support, yes, the short-term supports are established. But as I said, that possibly a double test of the previous swing lows is an ideal retest or a confirmation that the near-term bottom is in form.
Nuresh, you have worked on the small cap index in terms of charts. I saw some of your tweets. How does the setup look right now?
So the setup is simpler. If we look at the rally which started from March 23, we've had a rally from say sub 26,000, 27,000 small cap index to almost 46,780. As of yesterday, we had a 13-14% dip from the highs. We went back to the same lows which we saw in December 23. And at that point of time, Nifty was at 21,000. And the previous major support comes to around 38,700 on the BSE small cap index. That would make it a 17% dip from the top. And Nifty at that point of time was at 20,000. So I would expect 13 to 17%. This is the kind of area where we should create a short-term bottom. And overall, what happens is people want to buy the exact bottom. But the fact is, every stock in the small cap index will not bottom out with the small cap index, just the same way it did not top out on the upside. So out here from yesterday, like I've been mentioning, this is the time to cherry pick stocks, because some of the stocks may bottom out and say go up 20-25% from here rather quickly. And even if the small cap index dips again, they may not go back to the same lows. So the view is now is the zone where you want to keep looking at stock specific entry points irrespective of the index from here on. A 15-20% correction from the top on the small cap index. A lot of broader market stocks have already fallen 20 to 30% from the top. So there are opportunities to be looked at right now. Instead of looking at the index, time to go cherry picking stock by stock.
All right, let's take a short break on that note. When we come back, we'll put the spotlight on a little bit on macro side, some very interesting opinion on next generation reforms coming in from Sanjeev Sanyal, member of the Prime Minister's Economic Advisory Council. Sandeep, I'll play some bites for you shortly, and then we'll talk about capital goods space in order to participate in this growth when we come back. All right, so we spoke with Sanjeev Sanyal this afternoon on growth and the next generation reforms, which everybody is talking about, including our Prime Minister, and then we'll take the discussion forward with Sandeep.
The way to look at quality of growth is to look at the stability indicators. So are you generating high growth without generating inflation, without causing stress to the banking system, causing stress to your external accounts, and so on and so forth. And as far as quality of growth is concerned, in all of those parameters, inflation is running at about 5%, which is within the band. We are accumulating foreign exchange reserves. Our current account on the external front is well behaved. Our banking system is well capitalized and profitable. So none of those sectors are showing stress. So in terms of quality of growth, that suggests that we are generating high growth without causing macroeconomic stresses.
Sandeep, I want to understand, we spoke with the RBI governor recently. He said this year the growth should be closer to 8%. Sanjeev Sanyal earlier was telling us that now the aim of the government is to keep growth in the higher band, but on a sustainable basis rather than as a one-off. Are the valuations right to play this theme on the capex side and high growth side via capital goods stocks, and are there any capital goods stocks on your radar? Because till some time back, most of them got very expensive.
So Ajay, most of the capital goods stocks have not really become much cheaper. In fact, if you see like the stocks you're putting on the screen, L&T, Siemens, ABB, all of them, they have hardly corrected. Like L&T fell on the news of Saudi Aramco cutting down some capex, but then after that they won so many orders from the Middle East, including one large one today, that it's bounced right back. So the capex theme will remain intact, but I think such corrections. So on the mid cap side, we've still seen corrections. So I think something like an NCC, which went up to 265, it fell to 210, so 20% cut. I think such stocks and all we should keep in the radar and buy them whenever such kind of sell-offs happen. My view is on the mid cap side of the overall market, the correction is not yet over. Even on the large cap side, we could still see some more correction, and that will give the opportunity. Directionally, I think the Indian growth path will remain strong for the next few years, and they actually don't need too much of reforms, except for the fact that consumption in India remains very constrained because of very high taxation. But this government is not inclined to cut taxes, so I'm not sure whether some relief will come for taxpayers out there. But if they do that, then I think we could have a much more sustainable growth, which is contributed both by capital, capex, government, private sector, public sector capex, services, consumption, etc. Everything.
I also want to understand a clutch of PSU stocks, NTPCs of the world, PFC, RSC, IRIDA, many others actually have corrected reasonably from tops. Would that be a good idea to get into some of these names which are down 30-40%?
Yeah, if they're down 30-40%, we can start looking at it, but most of them are not down 30-40%. They'll be down barely 10-12%. And to that extent, I don't think they become any sort of compelling buy, because it's a very, very overbought sector. All retail investors, HNIs, speculative traders, everyone has got into them. So my guess is that the public sector index itself should fall another 10-15%, and some of the stocks in turn could fall 15-20%, and at that time there could be opportunities.
Oh yes, that's an important point. Thanks very much for your time, Sandeep. Let's move on and talk about a very important point which everybody is talking about, and that is the stress test of the entire mutual fund industry. It has been commissioned by SEBI. Everybody is talking about what it will entail and how it will be conducted and what will be the outcome of the stress test once the AMCs start sharing it with the market. Rishabh Desai, founder of Rupee with Rishabh Investment Services, will be joining us right after this break. He's done some early work around that, and we'll be taking that discussion forward right when we return.
Welcome back. Well, the market is holding on all right, except Bank Nifty, which is under pressure. The rest of the market has managed to recover quite a bit. But the big talking point in the market, of course, is what's happening with respect to the stress testing. And Rishabh Desai, as promised, is joining us for that. Rishabh, there's a lot of clamor in the market that maybe these stress tests are letting the mutual funds, change their portfolio and churn their portfolio a bit, which is also leading to a lot of volatility in the market. What's your take first, in the sense, if you can break it down for us? What exactly are those parameters that the SEBI has set out with respect to this stress testing, and could it actually lead to a change or churn in the portfolio or not?
Anisha, thanks so much for having me on the show. See, unfortunately, we are currently focusing on one parameter, what SEBI has said, which is the liquidity aspect. There are four parameters actually what SEBI and AMFI has told AMCs to publish from tomorrow. One is the portfolio liquidity. Second is the portfolio volatility. Third is the portfolio valuation, the overall market valuation. And fourth is what do you say? Like I'm sorry, I'm not able to recollect the fourth one. But basically there are 3 to 4 parameters what SEBI and AMFI has told the AMCs to publish. So I think at this point of time, there is no need to panic and worry at this point of time. Yes, I do agree with the fact that, liquidity can be a big concern, especially, in the lower and especially, lower small caps or the micro cap segment. But if you see the overall breadth of the market, right, it is quite decent. The liquidity in the mutual fund segment is being taken care by the mutual fund houses. And also, let's not forget that, there are 40, 50, 60 stocks in a mutual fund portfolio. So, I pulled out some very interesting data, Anisha. So if you see the current liquidity scenario, it takes the maximum number of days which it takes for a fund house to liquidate its portfolio, 65 days, which is SBI small cap fund, right? And if you see the AUM in the SBI small cap fund, it is around 25,000 crore. Now, on the other end, if you see Nippon Small Cap Fund, which is a 45 to 46,000 crores, right? It's taking around 14 to 15 days to liquidate its entire portfolio when, there is a redemption pressure. So, it depends on how the portfolio is being constructed in a small cap fund. It also depends on the individual stock allocation and how liquid the stock or how well it is traded on a daily basis in the market. That is also something very important what investors should ponder on to.
Rishabh, I want to understand that one is that, of course, the nudge coming in from the regulator side. But a lot of these fund houses have been very successful fund houses running in for decades, managing small cap, mid cap for the investor community for long. They would have developed their own risk management practices and framework very well too. How much further improvement can happen upon that? And this, this assumption that 85% of your portfolio, how much time will it take? Is that a very extreme angle to take in the first place?
Ajay ji, we survived 2020 market crash and we survived 2008, right? So those were like super deep market corrections what we saw. There is some froth in the market, absolutely yes, in the mid and small cap space. But is it the right way to say that are we in a bubble? I would say no. I pulled out some very interesting data what Edelweiss Mutual Fund had published. Over the past 2 years, see, I'm not saying that the mid and small caps are cheap or reasonable at this point of time. Absolutely not. They are definitely trading at a premium over their long-term averages. But over the past 2 years, what we saw, earnings have also caught up, right? And if you see the price to earning expansion in the mid cap space, it has been almost the same. And in the small cap space, the price to earning has expanded around 10 to 15%, right? So you are right in a way that, today we are in a much more equipped time and age what we were, say, like 10, 15, 20 years back. Mutual fund houses have their checks properly in place, I would say, because we already saw a liquidity crisis in the debt market in 2020 in the whole Franklin fiasco.
Right.
So, keeping these factors in mind, today I think mutual fund houses are very well equipped
Sure.
to deal with these kind of stresses what markets can throw to the investors.
Sure, Rishabh, they're very well equipped and they have done their own homework and gone through those earlier phases as well. But just quickly to wrap up the conversation, Rishabh, from the investor side of you, are you hearing any clamor around their small cap portfolio? Are the investors and the retail participants looking at maybe liquidating some part of a small cap, moving into multi-cap, flexi-cap or large cap category, anything like that?
I can specifically talk about my clients that, we follow a very strategic asset allocation strategy, whereby, we focus on the long-term aspect rather than the short-term. At this point of time, looking at the flows we have seen over the past 2 years, where around 60,000 crores have been inflowed in the mutual fund space, especially in the mid and small cap category. It is very natural to have some kind of profit booking or some kind of rebalancing in one portfolio. But, I don't see, in terms of a lot of panic amongst my clients, because, over the longer term, what we have observed is, mid and small caps is the only category which can give you better returns, compared to large caps. So, sticking put to your asset allocation and not going too heavy on the mid and small cap space is something what I would recommend. Having a balanced, well diversified portfolio is the key, because every market segment, whether it is large, mid, and small, will have cycles of outperformance and underperformance.
Okay, so having a balanced portfolio is paramount. Thanks so much, Rishabh, for making time and speaking with us. But Deepak Shenoy also joining us on the show, so let me take it across to him. Deepak, what's your thesis right now? Should one use these dips as a buying opportunity, even in the mid cap and small cap space, or let it grind lower, let the poison out of the system, and only then look at deploying?
So I think really the structure of the, it's not like all small caps are bad or all small caps are falling. Even large caps, there are stocks like LIC which fell, I think 4 or 5% yesterday, and now it's back up 5%. So I don't see that necessarily all such stocks which are small and mid cap will continue to fall. I think selectively speaking, you should definitely, where you have conviction, if you're buying on a fundamental basis, then yes, if you have conviction, then it's a good time to continue to add. As long as the fundamentals haven't changed. In some stocks, the fundamentals have. In some cases, there have been issues about certain large investors, say, being their accounts being frozen because of some inquiry and so on, which has kind of curbed liquidity in those stocks. So you might have to reanalyze whatever has happened. But outside of that, I would say, investing should be business as usual. This is how markets behave. This is how markets are. If they fall 4 or 5% in the small caps or 2 or 3% in the mid and the large caps, that should be normal course for the game. We've just been complacent. We've gotten complacent because the last year or so has been relatively benign. But this is how markets will give you opportunities to both buy and sell, upside and downside.
Okay, yeah, totally. I mean, this is business as usual, and the stress test that we are seeing in the mutual fund is also actually a stress test for you as the investor, whether you have the patience to deal with this or not. But time now to shift focus and bring Somit on board, because at least tomorrow there'll be that support coming in for flows as well, because FTSE rejig is expected to happen. Somit, what exactly will be the flow impact on account of that?
Well, it's not only FTSE rejig, but there are three rejigs, index rejigs that are expected to happen tomorrow: FTSE, Sensex, and Bharat 22. But of these three, it's FTSE that is most important, because that will lead to most amount of inflows in the market. In fact, to be precise, around $1.85 billion of inflows, net inflows, are expected owing to this FTSE rejig. Now, stocks that are expected to see the highest inflow: HDFC Bank tops the list, around $458 million of inflows are expected, followed by ICICI Bank, which could see an inflow of close to $382 million. Apart from that, it's Sundaram Finance, Kotak Mahindra Bank, Suzlon Energy, KPIT Tech, and Phoenix Mill, which could see an inflow anywhere between $57 to $163 million, and this would be nearly 1.5 to 3 times that 20-day average volume. Now, for Sundaram Finance specifically, if you see, the inflows of close to $163 million is nearly 10 times that 20-day average volume. Now, apart from this, a few other stocks that one needs to watch out for on the back of volume actions, and that is New India Assurance, Thermax, TVS Holding, Lloyds Metal, and Supreme Petrochem. Now, inflows on these counters would be on the limited side, around 10 to $34 million, but this would be nearly 7 to 15 times that 20-day average volume. So we could see that big jump in the share prices, or big bump in the volume on the back of these inflows that are expected owing to the FTSE rejig that is expected to happen tomorrow in trade.
Okay, point taken. So we'll wait by and see and wait for that rejigs to happen, not only FTSE but the other two indices as well. But just quickly taking stock of the markets. And Naresh, I want your view on a couple of these names. BLS International up 20%. You also have Shriram Pistons, which is reacting positively to that MK initiation, which talked about an upside of over 40%. And then the railway stocks are bouncing back today. Of course, all of them were under pressure yesterday. Within these 2-3 pockets, what stands out, Naresh?
So BLS International, even before yesterday, the stock had corrected from 430 to 330. And by yesterday, the stock was at 260. So that was a pretty large correction in terms of quantum. And we've recovered today. So overall, just a final bottom done for the short term. And going forward, dips back to 300, 310 would be a buying opportunity, would wait it out. Shriram Pistons, the stock is generally very illiquid. We saw some bit of block deals happen around that 1,000 to 1,250 mark. Then the stock had gone up to 1,800, 1,850. Yesterday was a dip, but overall a very illiquid stock. So would avoid as of now as a trade. In terms of railway stocks, one has to be careful. This bounce is a good time to actually keep reducing any further rally of another 10-15% on those names should actually be used to reduce allocations over there. I think we would be getting into a sideways consolidation of a major band for most of the railway stocks. Do not expect them to make new all-time highs.
Deepak, last 3 days in this accelerated fall, are there any names which coming on your radar you felt like nibbling into? If you could share some themes or at least names.
There will always be names we're continuing to be buyers. We've been buyers, small quantities, not much cash. So as new inflows come, we continue to buy. But on an algorithmic portfolio, that will be primarily determined by the data that is thrown out by the algorithm, and something like momentum, of course, does not result in too many buys right now, simply because there is no momentum in the market, or there is very little momentum in the market. But if you look at the fundamental part of the portfolio, I think a lot of our stocks have gotten cheaper, and therefore allocations can be put back into them. We were buying slowly. Now we can accelerate a little bit more of the purchases, regardless of where some of the stocks in the defense, even in the railway sector, even in the travel technology sector. We have a few stocks. I'm not naming them right now because we continue to be adding positions there. I think there is a lot of scope, because even though the prices had run up in the past, I don't look at that as the reason for fear, because I think longer term, if you've got a big runway and you can be at 10x from here, whether the price is 20% up or low, it's not going to make a major amount of difference to a long-term purchase. What matters more is how much money you can allocate, not exactly what price you can, whether it's 15-20% up or down. So in that context, a lot of stocks have become cheaper for us, so we're continuing to buy. I haven't added anything new significantly, at least not in the last 3 days. But we have taken some positions. There is also year-end tax based, selling or reconfiguration of taxes as well, which should drive some transactions. But otherwise, very, very little out of the ordinary transactions in the last 3 days. To be fair, I don't think this is so big a fall that I should jump in joy and add more significantly. That means change the whole portfolio. But it's also not. Not a small fall, so it allows us to add some more of our existing position. So I've not done anything new in the last 3 days.
Actually, just the news breaking on Biocon, and that stock is reacting quite positively. So they are informing the exchanges that Biocon Biologics, a subsidiary of the company, has approved the transfer of the business in relation to its branded formulations business, inclusive of metabolics, oncology and critical care, to Eris Life Sciences on a slump sale basis. And the details that I'm getting is the total transaction value is 1,242 crore rupees, which is almost 3.5 times the revenue of that particular business and 18 times the EBITDA. As part of the deal, 430 employees associated with the business are expected to transition to Eris Life Sciences. Biocon Biologics has also signed a 10-year supply agreement with Eris as part of this particular deal, and the transaction is expected to come into effect before April 15, 2024 itself. So that's the latest news coming in. Of course, the management is also saying it's a strategic collaboration that they're doing with Eris. So even though they are looking at paring down their stake, because the company has been looking at getting the money out of some of the businesses to pare down their debt and fuel their growth expansion as well, they say they are committed to a successful transition. They are looking at, weaning out some of these portfolio as well. But the commercial strategy to maximize the patient reach and market potential is something that they stand with. And overall, I think 1,242 crores is probably a good sum, given the revenue of this business for 412 crore. And this formed only a small part of the Biocon total business, because it was only 4% of revenue of the consolidated entity. But they're getting the valuation of almost 1,200 crore there. So almost 3.5x the value of the revenue, 18 times EBITDA. So the stocks are reacting, Biocon getting the money, and getting money for them is something which is paramount.
That is actually the bigger point.
Yeah.
I mean, this is just going the way Glenmark actually did, selling stake in Glenmark Life, and the direction or the messaging the market will actually get is that the management is quite serious in paring the debt on the main company, even if it means back-to-back deals. The previous deals actually came in when Serum Institute invested money in their biologics arm. Then there was a PE deal, and now a transaction And this 1200 crore which we are talking about, the proceeds of the lump sum, this formulation business sale, will actually come into the company. We'll probe the management tomorrow morning around it. But Sandeep, a quick view on Biocon. Deepak, a quick view on this this transaction, or the kind of messaging market would read that the management is in parts trying to reduce debt in whatever manner, just the way from Glenmark went from 300 to 900 on similar transactions and commentary.
I haven't actually seen the contours of the deal, so it just came out, so I don't have that much of a context. So, well, I don't know what 1200 crores means to the bottom line. And
fair, no point, no problem. What's your take on any of these large pharma companies today? Even Aurobindo Pharma commentary coming in saying that the generic business in US is improving and many of the key drugs are doing very well, almost going on the verge of saying that this quarter could be a very good one which we are walking in right now.
it could be. I think this is for pharma, this is going to be probably a return quarter after a long period of relatively. So we've had an issue with a number of things in terms of, the one big problem that we haven't had in the last 2 years has been the FDA coming in and doing a lot of warning letters and stuff like that, which I think is really the regulatory risk is in the future there, especially for pharma companies that are selling in the US. That may be one of the issues that will bog them down. Otherwise, it's been a long time. They've kind of been subdued in terms of performance in the stock markets. We've seen some revival, Sun Pharma, for instance, and a couple of other stocks as well. So I think interest in the space is starting to build up. I would personally wait another quarter or two. So if this is their quarter, let them show it in their numbers, and then maybe then I'll come back into it. So looking at FDA action as the only negative here.
FDA action, yes, and that's the black box that we don't know what is going to happen. But Kunal, tell us on the charts of Biocon and Eris Life, because both stocks are reacting to the news flow. What's the take? Would you be buyer after this sharp rally? Do you think it can extend further tomorrow?
Yeah, Biocon is something which I've been bullish on earlier, even though the stock had earlier shown signs of rally from 270 to 295, 305, and then even this leg of correction. I would believe after this price action move which you're seeing today, the volume is making a late comeback for the stock. I think this could be a very strong sign that this 240, 250 mark, which was tested yesterday for Biocon, could be a good formidable support for the stock over the very near term. I think traders should look at buying the stock at current levels, and I believe that this 240, 245 base could be taken as a stop loss for this trade, and on the upside, we should be looking at 305 as an immediate target.
Okay, so that's about Biocon, but can we please bring up the chart of Eris as well, because that too is reacting positively. So yes, Biocon is getting 1200 crore rupees, but Eris is the company which is paying that, and they are getting that portfolio. In fact, to divulge further and get more details, let's take it across to Shrishti. Shrishti, help us understand the significance of 1200 crores for Biocon, what Eris Life will get out of this, and overall for these companies, what really is the growth trajectory expected going forward as well?
Well, yes, so Biocon Biologics, which is a subsidiary of Biocon Limited, that is transferring a part of their business to Eris Life Sciences, where the deal value is actually of 1200 crores, and this will be on a slump sale basis, wherein Biocon Biologics will transfer the business of their branded formulations in India, comprising metabolics, oncology and critical care diagnostics to Eris Life Sciences on a slump sale basis. What they have said that the total transaction value is 1243 crores, and they have signed a 10-year supply agreement with Eris as well as a part of this deal. Now with this collaboration, they will expand the patient's access to different geographies as well, and this is indeed positive for Biocon, because this transaction value is representing 3.4x of the revenues, and it's at 18 times of the EBITDA, and 400 people associated with the business will also have a transition to Eris Life Sciences, and this is the collaboration that both of these companies have done. So decent news coming in for Biocon, where they are transferring their business at a good value, and for Eris Life Sciences, we have to look out for the synergies. Back to you.
See, any more sense on the valuations in the kind of the recent deals that have been done in the sector? Is 3.4x of revenue a good multiple to get, 18 times EBITDA? And also, what's the overall debt pile of Biocon at the moment? Because is 1200 crores substantial enough to warrant a 7 to 8% move?
So actually the news is actually positive. If you talk about the valuations don't look that cheap, but they don't look that that attractive as well. So a decent valuation for this particular business is what the company has given, and of course the management is positive and happy about it, where Shreyas Tambe has said that this collaboration will with Eris Life Sciences will align their commercial strategy to actually grow their India business, maximize the patient reach, and in terms of the valuations as well, a decent valuation coming in for Biocon Biologics. This strategy was actually told by the management earlier as well, and now they are seen to be working on those lines.
Just taking a look at the details in terms of the overall borrowings of, Biocon at this point of time. The borrowings were around 18,000 odd crores as of September, and the other liabilities were 17,000 odd crores. So 18,000 crore in context of that 1,200 crores is not material, but I think what the street is liking is they're walking the talk, because they have been talking about, paring down the non-core and non-strategic assets to, pare down the debt, and that's exactly what is happening. But shifting focus away from Biocon now, because there are a lot of other segments of the markets which are also participating right now. Take a look at Yes Bank. There seems to be a clarification that has come out from the bank as well, because in the morning there were some reports doing around that the company might be looking at selling 51% stake and changing the promoter. That is probably getting clarified by the bank on the exchanges as well. But, Sandeep, what's your take on these second level, third level private sector banks? Federal Bank and South Indian Bank came under the radar on account of those co-branded credit cards which RBI has stopped. Yes Bank is in the news flow. Would you be a buyer in any of these names for a big, alpha generation?
Would that be for me?
Yes, Deepak.
Yeah. So I think Yes Bank, the fact that it is going to be sold is probably longer term good for it, but short term it will create a lot of drain in terms of liquidity. It was not just SBI, it was SBI, LIC, and a bunch of other public sector banks that have given money to it. And I think Kotak has already sold most of its stake, and a bunch of others have still got stake. So once we've got clarity on who the next owner is, then we might, see where the bank goes from here. But it's not going to be easy, because it's going to need RBI permission and a bunch of others, and possibly an open offer as well. Considering that 51% or 49% at least is going to be sold eventually. So that, I think, is an off case. For Federal and South Indian, Federal has actually become a layer that offers a lot of banking services to the fintech sector. A lot of fintech organizations are using them as a conduit to help their customers get access to banking services. Long-term positive for Federal. Short-term, there will be some issues, because some of the startups have been doing activities that RBI does not like or does not want to grow meaningfully. For instance, personal loans or lending to relatively small ticket retail loans. Without the card frameworks, of course, the card frameworks are still okay. So I still think there's a lot of scope here for long-term appreciation in Federal. We don't have a position because we want to wait till the regulatory situation just clears up a little more. But I think that can be their alpha generation. I don't have a view on South Indian. I haven't done much of an analysis on that. But in general, I would say Federal's attractive because of its tech focus. Yes Bank's interesting because of this new ownership that might come in. We'll take more view as more data comes in.
Okay, point taken on some of those private banks. But Deepak, I want to do a channel check with you. How acute is the water shortage in Bangalore? Because CLSA wrote a note this morning talking about how the entire construction could get delayed. The likes of Prestige, etc., are coming under pressure today. I don't know if people are making too much of it, or is the water shortage really that acute in Bangalore right now?
Fair, we don't see it. I don't see it. I live in one part of Bangalore, and maybe because of the area we live in is continuing to get water, we don't seem to have an issue. Everybody is, of course, conserving it as much as they can. We've got notices saying, please don't go overboard in watering your balcony. So please use a mop instead. And so all of that stuff is happening. I think that's good in general. It's great to to save water, to save potable water. Most apartments in Bangalore have to have sewage treatment plants, so they all use it, use recycled water in the bathrooms and so on. So there is that in the flushes. But I think the more important point over here is to notice I think there was a person from the meteorological department and the Bangalore water supply department who said that we are adequately supplied till the monsoon. So this may be a little bit of a creation of some apartments having an issue, and then that's being translated to all of Bangalore. If you've been in Bangalore long enough, you get this issue once or twice, every 2 or 3 years, and then things just kind of pass afterwards. There are some parts of Karnataka that simply don't have water. This is the northern part. They've faced water problem for years. So Bangalore having that is not surprising. It used to be the case even much earlier, a decade earlier, and so on. I would say at this point, yes, this has been a crueler summer than most in the last maybe 5 or 6 years. It's much hotter than it used to be. So conservation of water is necessary, and I hope that monsoons come in early, which typically happens also, and then the reservoirs are back to full. I don't see this as a problem that will stop economic activity. It could, of course, I think the efforts to conserve water may require that some builders may have to slow down activity for a while, but I don't expect this to take more than 1 or 2 months.
Okay, so not a big issue that you should see a 5% cut perhaps on Prestige. Even Brigade is down around 1.5%. I would have loved to take in more views from you, Deepak, but short of time today. So thank you so much for joining us. But let me take the BTSC ideas from our technical experts before we let them go. Nuresh, you go first.
So first would be a buy on Tata Steel, which has corrected and come back to the retest levels. Stop loss at 139, target price of 148. Second is a buy on Infosys. Continue to like it. Stop loss at 1635, target price of 1700.
Okay, so that's the word coming in as far as the BTSC trade. Kunal, what about you?
I'll go for 2 buy calls. The first one is a buy on HCL Tech. Looks attractive in terms of breakout. So targets of 1715, stop loss at 1630. And Policy Bazaar is the other stock which I would continue to be bullish on. Targets of 1170 and stop loss at 1100.
Okay, point taken. So that's the verdict coming in as a BTSC trade. But just 1 minute left for the trading session, and it's not been a bad session at all. There has been decent amount of recovery that we saw for ourselves. So the Nifty ending the day close to the 22,150 mark. But the more impressive part is on the right side of your screen, and that's the advanced decline ratio. It's a complete reversal of what we saw yesterday. There are 1,900 stocks advancing to 500 stocks declining. Even though if you look at the sectors, it was bank which was under pressure. So, selective names from the banking pack like Axis, Federal, IndusInd Bank, they were all coming under pressure. Even SBI to that effect for the last couple of days has been under pressure. But what really stood out was metals all sank to Hindustan Copper, and that big rally that we have seen on copper itself, which is at 11-month high. So Hindustan Copper goes home with a 12% gain, and this is one of the top picks that our technical experts had flagged out as well. Jindal Stainless, Adani Enterprises, Hindalco are some of the other names from that vertical which were reacting quite positively. From the broader markets, just wanted to flag out BLS International up 20%, Electra Green Tech up 13%. A couple of these railway names, IRFC, Ircon, Rights, these were in focus as well. And then Central Bank of India, Yes Bank, these were some of the names that managed to actually stand out. On the losing side, Prestige down 5%, Sterling Wilson Solar for second or third day has been on the losing end today, and heavy amount of volume on that one. You also had BKG, Chola Holdings, Keynes Technologies. Some of these names were definitely in the red, but the overall advanced decline ratio was much more healthier today. And the weekly expiry has also happened close to 22,150. But the big question is, how will Friday pan out? Because it's been a very topsy-turvy ride. We'll see that tomorrow morning at 8 a.m. with you. But for now, thanks for watching. That's a goodbye on Closing Trades.
If you like this video, then like, share and subscribe to ET Now.